Hi, all. Welcome to the Riot Lunch and Learn series, the place where we spotlight Riot sponsors and partners. My name is Jen Morgan, and I'm the Virginia program lead for Riot. Just a couple of quick reminders before we get started today. This event is being recorded and will be posted to Riot's YouTube channel and uploaded to the meetup pages where you registered for this event. If you have any questions throughout the presentation, please place them in the chat. We ask that you please place questions in the chat so that they can be read aloud for those watching the presentation at a later time. All questions will be read aloud throughout the presentation. Finally, please keep yourself muted throughout the event to help mitigate any background noise. Today we have with us Pete from Fourscore Law, and I will turn it over to you to start today's presentation.
Right. Thanks so much, Jennifer. And welcome, everyone. Thank you for taking some time, whether it's your lunch break or not. Appreciate you joining. So I'm going to keep it sort of conversational to the extent I can. There are a few slides just to get started here. But a quick intro to the program. This is going to be about mergers and acquisitions, M&A. And the sub theme is Get Out, kind of in the spooky vein of the film by Jordan Peele. Spoiler alert, if you haven't seen it, there are a few analogies I'll be pulling from the film. Great socio-political commentary, but this will kind of be more toward the business applications and hopefully some lessons learned from the film, from some clients of mine. From headlines, recent stories, the whole nine. But a quick overview of Fourscore, my firm. I'm kind of double branded here today with the hat and the sweater. I'm going to try to share my presentation here. One moment. Okay. And that's the wrong play button. We will go slideshow. Play from start. All right. So Fourscore Business Law started up in 2017. I joined forces with them just a couple years later, tail end of 2019. So going on 4 years with Fourscore. Great shop in the Triangle area for those of you who are as well. And our ethos or theme, trademarked, is ideas deserve opportunity. So one of those things is that we try to handle pivotal moments for companies, one of which is mergers and acquisitions or M&A. Other flavors of that are venture financing, which a few of my colleagues have presented on for Riot, and the day-to-day outside general counsel. So our aims are to simplify the complex, kind of make everything accessible, understandable, communicate clearly. That's both to our clients and anyone we're up against in some contexts, to see the big picture and to not be a suit to the extent we can avoid it. Some areas of practice, as I mentioned, VC, PE funding is kind of our sweet spot, bread and butter. Mergers and acquisitions is where I spend most of my time in the mud. That's either with equity deals or asset deals, some flavors of both and mixtures that we'll talk about. And then outside general counsel services, that's anything from formation all the way through the exits that we'll be talking about here. So that's enough of a spiel and a pitch. I do want to touch on the timeline of our clients and companies, just because it kind of bears some relevancy here for this discussion. So it's an ebb and a flow, up and down, no straight line toward profitability or to exit. But we do help with every piece of this along the way. Once we're starting up, it's kind of the excitement phase. A lot of times it's a fresh idea, new thing for you and for the market. One of the first pivotal moments we help clients with is fundraising, whether that's from outside investors, or even helps with getting other partnerships and relationships together. If it's license agreements with universities, other sorts of grants, and ways to get your footing to move forward. So that leads into product development, failures, refinement, adoption, growth, market penetration. And then once you're there, that's kind of where these events will be speaking toward start popping up for exits. And that's through mergers, acquisitions, IPOs in some cases. But really any strategic combination of your business that you've taken from infancy all the way through with another business. That's the exit event we're speaking to here. So why sell? Besides money, a lot of times there are various reasons. A big share of our client base is kind of toward the natural retirement age, and they are just looking to transition, sort of tired, for lack of better terms, of running the business, handling day to day. So secession is one thing. Some other flavors are if there's opportunity that pops up where your business can combine with another, either create some value out of nowhere or leverage what you've already built respectively. That's kind of the merger flavor of exit here. And then IPO is you're kind of giving the company over. It's called an initial public offering. So the stockholders won't only be the private investors you've gathered, but anyone, anywhere can sort of buy a piece and own a share. So those are kind of flavors of reasons to come to the table. Strategic combinations can come from competitors sometimes, or out of nowhere, and we've seen a fair share of both. When worth mentioning, when it is a combination with a competitor, a lot of times people don't think about it, but there are some antitrust wrinkles to work through there. You do want to be sure that what you are putting together and combining doesn't create a situation where the market isn't able to price what you do fairly. So a few laws around that we don't really need to get into, but you do have to be aware of some dangerous combinations, for lack of better terms. Cashing out is kind of the best case scenario and aim, or kind of distress is the other situation companies can run into, whether you're on the verge of bankruptcy, needing some sort of bridge financing, or a punctuation to the operation altogether. So distressed asset sales are something we see often. Whether you've built a portfolio of value, whether it's intellectual property, the people that you work with that may be able to be leveraged for another operation. M&A is a good way sometimes to hand over something you've stewarded and can no longer take the same level of care of. So that sort of brings us to an overview of the process. And I'll start kind of interjecting some of the apt analogies from the film Get Out here. So the NDAs, CIMs, IOIs, MOUs, LOIs, those are all alphabet soup acronyms for confidentiality agreements, basically, or term sheets. Those are pretty much where the conversation usually starts with an acquirer. You'll want to both be sure that whatever you're sharing as part of the process, the due diligence and negotiation, isn't used in a way that you wouldn't want it to be. So confidentiality agreements, NDAs, they sort of set the floor for protection going both ways. We do, and to that point, we do try to make sure that those are mutual or bilateral. is the other term. A lot of times when a purchaser comes to the table, they might try to use what's called a unilateral or one-way NDA, which doesn't do you any good as someone that's spilling your guts and handing over information. So we do try to make sure that information coming in, going out, it's all protected. You can share it usually with representatives of yours, anyone on a need to know basis, your counsel, your tax advisors. But that should pretty much be the universe that those things live in. So not the press, not social media, not other competitors or anything like that. After the floor is set, a lot of times there's going to be a term sheet that'll kind of embody the aims of the transaction, whether it's a stock deal or asset deal would kind of be laid out there. Any other structural pieces, so if a merger subsidiary is going to be set up and part of the deal, that's usually where the steps to the process would be laid out. A timeline for due diligence, a timeline for drafting, and some sort of exclusivity period is also pretty common. So the potential acquirer will want to make sure that your undivided attention is kind of focused their way, sharing any materials they need, and really giving them a full fair shot to buy the business. So that's sort of step one is NDA, LOI, often kind of one in the same part of the process. You kind of move and graduate toward negotiation and valuation. So the initial purchase price is often either put in there with an asterisk, or it's punted up until after a few other pieces of the process are ironed out. So the data room and the due diligence are a big informer for what the company is actually worth. So that's everything from financial reports, balance sheets, profits and loss statements, contracts with your biggest customers, measures of recurring revenue. Most times a buyer in coming to their purchase price will use what's called a multiple of a figure called EBITDA. So it's earnings before interest, tax, depreciation, and amortization. And it's basically just a measure of your company's financial health. The multiple can vary industry to industry and time to time. So there's really no set price point for a specific company. It'll change with the market, as most things do. But you do want to make sure that the multiple you're getting is somewhere near market, if it's not beating it. And some ways to figure that out are to check out some resources like PitchBook, is a pretty decent tool for deal size and some other metrics. And just good old Google or your network. If you know of any other business owners that have sold, you can kind of talk to them about when that happened, how that happened. And those are pretty good flashpoints for information. So term sheets and offers, they're often at the front end and in the middle. So after you kind of get some of the air kicked out of the tires, after you kind of see the inside through a data room of what's really going on with the company, after you have some conversations with the people that work there or the vendors and other people that touch the business, that's kind of where you have a better sense of the price point and the value. So often a term sheet or an offer will come after the due diligence phase has been pretty much complete, and you'll move forward toward documentation and actually putting in place the deal structure that you want to lay out. This process can be quick and dirty. It can be long and clean. In my day-to-day, I kind of have a pretty good mix of both. So I know how to be nimble if need be, or how to do the long hours and push toward making it happen. But we usually do like to have some cushion. So usually between 30 to 45 to 60 days for the drafts to be prepared and revised. So there's usually some volleyball, some back and forth between buyer counsel, seller counsel, ironing out terms and sticking points that we'll touch on after a little more conversation. But closing and post-closing are kind of where those documents are signed, the keys are handed over, the buyer becomes the new owner. And integration is one of the last bullets, one of the most important pieces. And in discussing the horror stories I'll touch on, that is kind of the missing ingredient in a lot of these scenarios, is effort toward integrating one company's business with the other, how those operations might overlap, where some fat can be trimmed, sometimes whether it's inventory, personnel, the whole nine. There has to be conversation, I think, for the deal to be successful before handing over the keys to the kingdom, for what will happen with everything that you have taken time and effort and years to build, whether it's the workforce, even office furniture and things like that. From a optical stand, the brand you've built, how much of that is maintained is really up to this integration piece, and that is very much a sliding scale and spectrum. And if you don't specifically address points, it's often left to the buyer, and a lot of times they will do things differently than you have, and they may do things differently than you'd prefer. So if things are important, like the workforce, which I'll mention and emphasize again, it is really important to set those parameters, those expectations, and have agreements that line up with what you envision for the next phase and era after the M&A deal is done. So rollover is a really interesting quirk and piece that I've found come up more lately than before, where a seller will not ride off into the sunset and be entirely done with the business, but instead they will reinvest some of the purchase price, some of the sale proceeds, as a purchase of stock of the buyer, equity in the buyer. So they're still kind of in the mix, in the fray. They still care to some extent about what happens and how. That can be either just at an ownership level or even at a managerial level, either maintaining a board seat, an officer role, anything along those lines. Those are all kind of flavors of rollover, which really just means that some of the sellers or the old guard will have part of the new combined business. And we'll get into that a bit. So considering offers and bids, this can get either really interesting and complicated or be pretty simple. So it kind of depends on what you want. If it is just a strategic combination with a business that you already know is sort of primed, ready, able to take over what you've built from day one, that usually is the scenario where these other things don't matter as much. The value of a broker, from my perspective, and they might speak differently, but the value of a broker is to shop around and look around. So essentially, you don't only want one prospective purchaser if you can help it, and if those other kind of soft factors don't matter as much. You really want a bidding war to the extent that you can prompt one, for a couple of reasons. Obviously, that drives up the price point from a competitive standpoint, if one buyer wants to beat the next to the punch. And it may also present some other opportunities to shape deals and sweeten things in ways you wouldn't think. So it kind of depends who's on the other side of the deal, what they're interested in, and what they ultimately want. But I have found that the the process for competing bids usually yields a better result for sellers. It makes you think through things you wouldn't necessarily think to, and it does present an opportunity to look at what your business could be in different spheres and contexts. So not just the one potential buyer, but maybe some other strategic combinations that could open up your world a bit. So there's economic, of course, and other factors to consider. But the piece I really want to mention here is reverse due diligence, which is a big part of my day-to-day, is kind of looking at the buyer. Of course, they have their due diligence process where they're asking for everything you've ever done, like the interrogation hotlines on you. But I do find it not just from a negotiation standpoint, but also practically. You want to know who you're working with, who you're getting in and getting out with end of day. So checking on their track record, if they have had other mergers, talking to those founders, and really getting a sense for their portfolio. If it's a firm on the other side, how happy those sellers are. And that's not proof positive that your case will be exactly the same, but it is usually pretty good indicia if you check out their track record, their history. And the other piece is the current valuation in rollover deals. That'll be a pretty big point, sticking point in some cases. So you want them to be as forthcoming with their financials, their metrics, their plans as you have been yourself. Really kind of putting on the investor hat as the rollover seller and understanding that whatever value they are converting into their own buyer stock, you should be getting bang for your buck there. So it's sort of my posture, and this has worked a couple times, not others, has been to say that as a rollover seller, we are looking at the buyer sort of with wearing the hat of like a venture investor. So we would want to see all of their organizational documents, their financials, their plans, to know if that investment literally is worthwhile. And again, it's worked sometimes and not others. So data room and diligence. A lot of times, this is like the biggest deal for companies. And whether it's been family run, closely held, mom and pop, or even more established, there is often a lot of cleanup work to be done, whether that's just making sure the ownership cap table is clear, that there are documents that actually give those shares and you can kind of trace them back. So there's a chain of title, so to speak. So you know what you're selling is actually there. Or even other stuff. So making sure that if you had conversations with employees, for instance, about them owning equity, them having an option plan, option pool, you want to make sure that exists, that it's reality, especially before closing on a deal like that, because that's kind of when it matters and counts. So other pieces here, it is important to note debt comes before equity in terms of closing proceeds. So if you do have loans on the books, those are usually kind of top line. The exercise I try to get my seller clients to walk through is to understand that the purchase price is minus that. So you're not splitting the entirety of those proceeds unless you are debt free. And there is some flexibility. So some lenders do allow debt to be assumed by the buyer, by the next owner. But a lot of times it's written into whatever shape the loan agreement takes, that a change of control would trigger an immediate repayment, accelerate the loan, the whole nine. So I would kind of just consider that to be the structure unless you know otherwise. But debt before equity. And then the other interesting pieces in deal structuring are tied to tax. Not my main area of expertise, but I have to know enough to be dangerous. So some quick things to consider are that C corps, so corporation that hasn't made what's called a subchapter S election to be an S corp. A C corp is usually eligible for what's called qualified small business taxation, section 1202 of the IRS code. And that pretty much means the first $10 million of an exit or a sale would be tax-free. And that's a really big deal for sellers. That is subject to a few things. One is a holding period, and the other are kind of criteria. You do have to not be involved in certain industries or lines of business. And there are some actions along the way that can bust QSBS eligibility for sellers. So it is something to consider if you're kind of weighing to start LLC or C Corp or make an S election. The QSBS thing down the road can count and matter. So it's something to add to the analysis. And the other piece is what's called an F reorganization. And this can come into play when it's a merger of the business that's not so much based on cash compensation. But this is more for the rollover flavor. If you meet certain marks, you can also avoid tax hits that way, which I think we all aim for and love. So yeah, that's the end of the presentation, but not the end of the conversation. So the analogies I wanted to bring in here, again, this is alluding to the film by Jordan Peele, Get Out. Again, spoiler alert, if you haven't seen it, you've had a few years, so there's no excuse. But the premise essentially is that in order to live forever, a group of people decided to take over the bodies of another group of people, sort of to abduct them, to inspect them, to do surgery, and essentially make their minds live in the bodies of the other. Sort of a weird and gory take, but one of the first thoughts I had when I saw it is that this is a lot like the business case for that application. Essentially, a buyer, they want to take the brains of their operation and bring it into what you built. So whether that's the intellectual property portfolio, the personnel, the name brand, any of the like, the aim is to live inside of the target in most cases. A few cautionary tales from that. So you don't want to be caught unawares that is what's happening. Essentially, when you are involved in M&A, I do try to do some coaching and counseling for what it means to sell. A lot of times, there's kind of, like I said, the vision of sailing into the sunset, never touching the business again, is one approach. But a lot of times it's not the only way. So there's rollover, as I mentioned, where you're still part of the mix, still part of the ownership or management of the new combined business. And the sorry, got a distracting call. Essentially, you don't only want to make that the approach. So a great way to avoid a few of the horror stories I'm going to touch on now is with an eye toward what you really want from selling your business. If it's a complete cash out and a get out, that's good, and you should approach it that way. But if you do care specifically about anything you've built, whether it's the IP that you don't want to change from a branding standpoint, whether it's the personnel that you want to have some protections against being let go, production moved overseas, any of that. The M&A process is the place to work those things out and to really decide if you're hands off entirely, or if you still want to have a guiding hand in the next phase and iteration of the business. So one cautionary tale, real life scenario, not my client, but kind of hits close to home from a couple standpoints. So I'm a musician on the side. One of the instruments of choice for me is Moog synthesizers. So they're homegrown North Carolina business, based in Asheville. And earlier this year, they had an M&A, an exit, with a global brand called In Music, that has since proved to be a horror story for a lot of the Moog personnel. About half of their workforce was let go a little over a month ago. Production primarily has moved from Asheville to split between Taiwan and China. So a lot of the brand identity, I actually left mine at a gig on purpose, so I can't point to it. But they used to actually have employee owned branding and placards on their instruments because it was a principle and part of what they did and part of what they built. So that's gone off the new products. Their employee stock option plan did pay out. So anyone who was a current or past participant under that got some of the sale proceeds to In Music. So in that regard, I think the both the founder and the current ownership had some care toward those folk. But the next iteration, the next phase, was not as carefully dealt with. So what we did see is the employee ownership plan not be re-implemented. It went away, obviously. And when a private equity shop buys you and owns you, they usually intend to profit. So a lot of times it'll be, as I mentioned, trimming fat as they see it. So they may not know the true inner workings, the true heartbeat of the office, whether it's a secretary or a manufacturer. And that's sort of why the integration piece I mentioned, it's one bullet in part of the process, but it can make all the difference. So the buyer really understands the value prospect, not just of the business as a thing, but as a living, breathing organization of people that it's made up of. Excuse me. So I consider Moog to be a horror story of sorts. Owners made out, some employees that were participants of the plan made out, but the brand as a pillar in North Carolina and beyond, and in the musician community, has taken a big hit. So there are sort of talks of protests and not buying any equipment anymore. I'm not quite in that camp since I do M&A day to day. I get it. I understand what happened. But I think just the disconnect between what they built and what happened is a great divide and something really to consider protecting against when you are structuring deals.
Keith, that's a great horror story. We did have two questions that arose, and I wanted to note those. But the first is, at what point does it make sense to seek the advisement and services of an investment banker or business broker?
Yeah. I'd say as soon as you know you're ready to sell, that's the best time to have the first conversations. A lot of times they'll be aspirational, not much to it until there's a prospective buyer on the table. The other kind of pivotal point where I think an investment banker or a broker makes a lot of sense is when you get your first offer in. You might want to check with them about those terms, whether they're market, whether they're on point, and whether they can get anything better. So I'd say those are the two real prompts from my perspective: when you're ready to sell or when somebody else comes to the table.
So you could say that both like from a buyer and seller side, it's important to have the advice of an IB or broker.
So buyer side, not as much. I think they can help if you have an issue finding a target that you want. But usually a buyer will kind of come in knowing the target, knowing exactly the company they're looking at. Um, I think there is some value add for brokers on that end, but it's not quite as much as for the sellers.
Awesome. Thank you. And please continue down any other horror stories that you have. If you don't have any, I have a couple of questions myself.
Yeah, open to questions for sure.
Okay. Any questions from the audience? Please feel free to put them in the chat. But I think a couple questions that I had, keeping on the get out theme, do you like ever work with clients just in general as entrepreneurs and other aspects of their business that you've seen come to the table where you really need to tell them to get out, let things happen, don't hold the baby so close?
Yeah, that's a good use of the analogy. Uh, and kind of important. So from an M&A standpoint, sometimes the owner seller can kind of get in the way of negotiations if they are kind of either too zoomed in on certain deal points or certain aspects of the business, um, or just like overly pushy with the process. So a few times, some reality checks and testing are needed. One, to get them to see the big picture, and know that any points that are kind of conceded or given up in the grand scheme may sway leverage for a more important point later on. So that's one thing, to zoom out, and then to let the process play out, I think, is another really important thing. A buyer won't close until they're good and ready to pay that money and know that they're getting the thing that they want. So due diligence takes time. They need a lot of information to get the comfort that they want. They haven't had the luxury of seeing the guts and insides of your business for the entire lifespan as you have. So they're getting up to speed. They're learning a lot in a condensed time frame. So I always encourage patience with that process.
Awesome. A question from the audience is, what are the most common mistakes that companies make in M&A deals?
That's a great question. I guess commonly uh, is not enough due diligence. That's kind of the most prevalent issue I've seen, is being surprised by things that come with the business, and them turning into indemnification claims, which really just means that you're going to go after the seller either for some amount, pretty much a refund of some portion of the proceeds, because this thing happened and played out. Um, I would generally say you're usually able to pick up on those things that can happen with a good due diligence process. They'll have either come up before. um Old adage that there's nothing new under the sun really usually plays out that way. And what you don't want to be in the scenario of is where that information was handy and available to you, but that you didn't take the time to dig into it, in which case it's kind of on you if you didn't protect, from a drafting standpoint, protect against that happening again. More specifically, provide that it's a seller responsibility. Then that's kind of damage after the fact, and it does sour things, I think, that could be solved instead.
Awesome. Another question is about how much would it cost to complete a deal at 10 mil, 50 mil, 100 mil, including legal fees, investment banking fees, other expenses? Give us a ballpark. What are we thinking about?
Yeah, I unfortunately have to give the lawyerly answer of it depends on a lot of factors, but uh the named levers I see that drive up pricing or drive down pricing is the amount of cleanup work that has to be done going in, the complexity of the structure. So if it is something that we're aiming at doing tax free and have to be sensitive of certain pushes and pulls, that can often lead to a higher price point. Um, and then banking fees are often kind of graduated. So there's like a 5% cut of a certain dollar amount, 4% cut of a lower dollar amount, or higher. I kind of forget how that works from time to time. But it's called the Goldman scale, I believe. If you want to look into that. But usually to the question, there is a pretty significant portion of the purchase price, usually nowhere near half, but kind of in the range of 10% or so, that in aggregate goes to paying all the people that do the stuff and do the work to make it happen. So 10% is kind of a price point of sorts, but it's definitely not definite. And there's a lot of wiggle room there.
Awesome. The next question is, what are the biggest red flags in the target company's due diligence?
Again, it kind of depends on what you're dealing with. The biggest things I usually see as red flags are huge customers that don't have contracts with the target, or the contracts like specifically are anti-assignment, which essentially means that if you do a deal like an M&A deal, that the vendor or the other side will have an opportunity to renegotiate with that new owner. Not necessarily a deal breaker, but it does introduce complexity, and kind of an opportunity to retrade that usually goes in favor of that other party. But yeah, I'd say that's a big one. There are all sorts of things that come up, whether they're unpaid taxes in certain jurisdictions, liens, and like UCC financing statements that are holding up the assets so they're not free and clear to hand over. All of those things are sort of what we look for, and more, of course. But yeah, I'd say anti-assignment provisions in contracts that matter to the business are something to look out for sure. And not a red flag per se, but definitely something that'll need to be dealt with.
Okay, and the next question is, what are the most common post-merger disputes and how can we avoid them?
Great question. And thanks for all the contribution there, Greg. Um, the ones I've seen are usually indemnification claims, as I mentioned. Um, Again, it's kind of the buyer being supposedly caught unaware of a certain issue, comes to light, and then they're hit and hurt economically, so they go after the seller to cover. Some other kind of uh ripe floor for disputes are when it comes to earnout provisions. Um, so rollovers is something I mentioned. Earnouts is kind of a different wrinkle, to where some of the purchase price depends on performance, hitting milestones, certain revenue thresholds, kind of whatever you make it. But unless that thing happens, some of the purchase price is deferred and goes away. So a lot of disputes kind of hinge on when those earnout triggers are unclear, and who's doing that measurement, who's kind of counting the beans and making sure that if those marks are hit, the price is paid. A lot of times it'll be up to the buyer to say, hey, this is what we collected, this is what you're owed. And sometimes the buyers are not honest about that. So if the seller knows that one of their bigger customers continued on, paid a certain price that's not reflected, So reviewing those statements that should be provided. What you can do to avoid those disputes is be clear about measurement, about metrics, and even leaving those things to outside parties or appraisers when you can, just so one of the sides that cares, if it's in their pockets or out of their pockets, isn't really the decision maker. A lot of times that's a great way, but I really think that drafting carefully and kind of considering end of day how this plays out is really the best way to avoid those post-closing issues.
Awesome. Thank you. Anybody else have any questions? Please feel free to put them in the chat. But in the meantime, what's the best way to get in contact with you?
Great question. So fourscorelaw.com, and it's Fourscore is our website. I'm Pete Singh, and I have a profile there. You can also kind of set up consultations with me free of charge for the initial conversation. There's a Calendly that I use to kind of manage my life, but also meetings. And that's a great place to look at my availability, grab some time. I do like to have conversations with new people, hear about what you're up to, figure out how we can help if and when we're the right fit. And I will go ahead and put my Calendly link in here.
Awesome.
Well, I think that's a good idea.
Cool.
Yeah, and I'm really appreciative to Riot, and I know Fourscore is kind of a recurring character on these presentations, but we do really like to provide value when and how we can. This is one way, so you all can just consider us a resource now and moving forward.
Thank you again for such a wonderful presentation. We appreciate Fourscore and everything that you all do, especially to help the startup community. And as a reminder, Riot hosts these lunch and learns weekly on Wednesdays at 1 p.m. Eastern time. You can find a list of our upcoming lunch and learns on our website and the meetup pages where you probably registered for this event. This event was recorded and will be posted to Riot's YouTube channel. Thank you all so much for joining. Thank you, Pete, for telling us such a great thing and the references right ahead of Halloween. And I hope that everyone has a great rest of their day, and we will see you all later.
Yeah, thank you all.
Thanks. Bye.